Hello and good morning. I'm Olivia Rios at the LA Latino Chamber, and I welcome you to today's webinar. First, we want to thank you for joining us for our webinar, How to Obtain SBA Financing 504 and 7A. We know that your business is not just your career, but it's your legacy. Whether you're looking to purchase your first warehouse, acquire a competitor, or simply stabilize your cash flow, the path to funding can be a maze with all the requirements. That is why we brought together a panel of experts from our partners at US Bank, one of the nation's leading SBA lenders that aren't just here to talk about numbers, but they're here to help you understand how to use these powerful tools to scale your business. At the end of the webinar, you'll have a clear roadmap to two of the most popular SBA programs, and that's 504 and the 7A. We have a panel of experts, which includes Eddie Reyes, Vice President of Relationship Management, Omar Kaharzada, SBA Development Officer, and Eddie Santos, Business Development Officer. But before we start, we'll ask you to mute yourselves. You can ask questions in the chat box, or if you look at the slide presentation, there's a QR code at the bottom, and you can ask your questions to Eddie Reyes directly. All questions will be answered at the end of the program. And with that, I turn it over to Eddie Reyes.
Great. Thank you, Olivia. And good morning, everyone. It's great to be with you. And a big thank you again to the LA Latino Chamber of Commerce for inviting us back to kick off this year's education series. A little bit about myself. I've been in banking for 20 plus years, done a ton of different roles within banking. But again, business has always been my passion. So happy to be here and always love presenting to the LA Latino Chamber of Commerce and its members as well. So, let me just jump right in. The way Olivia marketed this webinar is spot on. Capital is the lifeblood of any growing business, and today's session is designed to simplify what can feel like a daunting and complex path, and that's accessing SBA funding. The Chamber is partnering with US Bank for a deep dive into the SBA 504 and 7A loan products, so the pathways to secure the funding that your business really deserves. Our goal today is education, right? For all LA LCC members and for any non-LA LCC members, welcome. Whether you're an owner, advisor, or community partner, hopefully you'll leave with a broader understanding of what's available, determine fit, and move forward with confidence, either with US Bank or your respective bank. You'll hear from me and industry experts like Omar Karzada from US Bank. You'll hear from Eddie Santos from Business Finance Capital. We're going to connect program rules to real-world use cases that will hopefully help you start viewing SBA financing as a strategic tool for strengthening and growing your business. So let's dive right in. I always like to include this slide here. It's just a brief overview, but the SBA was established in 1953 to ensure small businesses can access capital and critical support. Its work centers around three pillars: capital, which is financing for growth; contracting, which is access to government opportunities; and counseling, which is hands-on guidance. On the capital side, SBA loans can be used to fund, real estate purchases, construction projects, equipment, working capital, inventory, and much more. Often it's a good alternative where conventional structure might be a bit tighter. At a high level, the SBA program, I like to call it a Swiss Army knife, right? Of business financing. It's flexible, it's multi-purpose, and able to support a wide array of needs. By comparison, the SBA 504 is more specialized and designed really to support financing long-term fixed assets, through a partnership with a traditional bank and a certified development company, which you'll hear from Eddie Santos in a little bit, which has been a great partner of ours. So the next slide real quickly is the 3 R's of SBA. SBA lending supports essentially 3 essential needs: recapitalize, restructure, and retain. Recapitalize, it does this by injecting working capital or consolidating higher cost debt to strengthen the balance sheet. Restructuring, SBA enables longer amortization periods, lowering monthly payments and improving cash flow flexibility. Retain, lower down payments, often as low as 10% down, which help preserve cash for operations and growth. Given the tighter credit conditions over the last several years, SBA programs remain a vital way for healthy businesses to secure long-term and manageable payments, right? So you heard from me a little bit, but now let's move it over to the experts. I'm going to transition over to Omar. With that foundation, he's going to break down how the SBA 7A works. First, on an owner-occupied scenario, if you will, and then also non-real estate as well. So Omar, over to you.
Sure. Thanks, Eddie. One of the SBA programs that are available for the purchase of real estate is the SBA 7A loan. And like Eddie was talking about, so the main function is the lower down payment for these programs. It's only a 10% down payment requirement. The funds can be used to purchase real estate, do construction, refinance if you have an existing loan that you want better terms on. The amortization is 25 years fully fixed. The SBA does not allow for any kind of balloon payments, so you're not dealing with any kind of having to refi every 5 years or 10 years. They automatically reset for you. Obviously it has competitive pricing. There's no origination fees on the 7A, and the maximum loan amounts up to $5 million. So the 7A program is very flexible, and as you'll see in the next slide, you can utilize it for not only real estate, but also non-real estate. So this is where really the 7A kind of, shines a little bit on the non-real estate stuff, because anything a business needs to grow or to, debt consolidate or acquire or expand or any of these items, the 7A can be utilized for all those purposes. So there's a list on the right-hand side, obviously business acquisitions, partner buyouts, equipment purchases, debt refinance, improvements, working capital. So anything basically that the business would need, you can utilize the 7A program. Now the non-real estate program, the max amortization on those are 10 years. And in certain situations for certain types of equipment, you can go up to 15 years. Another benefit of the 7A non-real estate program is that there is no prepayment penalty. So you could pay it down, pay it off whenever you like. And it does not need to be fully collateralized by real estate. So it's a flexible loan program that can be utilized for anything the business needs to grow or to kind of improve cash flow, et cetera. This is an example of a recent deal that we did. It was for a food distributor company, and they mainly distributed like grocery items like Tajín and Paramex, Nestle items. And it was an importer, and their main, the countries that they imported from was Guatemala and Mexico. And as you guys know, earlier mid last year, there was a lot of tariffs that were being implemented by the government. So this company, had to utilize their existing line of credit to kind of stock up on inventory to avoid the impacts that the tariffs are going to have. Is going to be an extra 30% tariff. So before that happened, they utilized their line of credit to kind of max out their inventory. And so when they came to us, we looked at the balance sheet and kind of saw that, look, they were pretty much tapped out on their inventory or on their line of credit. So we used the 7A program to refinance that debt. We re-amortized that $500,000 over 10 years, and then we also extended a line of credit so they can continue to grow. So, it was a perfect fit for that client. They were very happy, with the program, and they're able to continue to grow. So that's some of the benefits of the 7A program.
Yeah, and before we go over to the 504, if I could just jump in real quickly with Eddie. Just I didn't forgot to mention this, but on the right bottom corner of the slides, there's a QR code that actually leads to my information. If you have any questions, you can always take use your camera and take a picture of that, and it should bring up my information. In addition to that, Olivia, I think we're monitoring the chat, right? The chat box as well. Please feel free to write in any questions you have, and we'd love to answer this at the end of the call. We're going to leave probably about 20 to, 15 to 20 minutes at the end. So please ask your questions, okay? So Eddie, why don't you continue with the 504?
Thank you, everybody. It's a pleasure to be here and bring some knowledge to people. We talk about SBA all the time, and it's kind of one of those things where we do it so much that we forget there's people out there who don't know much about the program. So these moments are very important because you don't ever want to assume that everybody knows everything. And so if we have to break it down from the beginning to smaller steps to bigger steps, that's something that we should all be doing for whatever things that we do in our lives. First of all, I just want to commend the 7A program. It's a very great program. It's very powerful. And let me tell you why. It's because, like Omar just said, it's got so many facets to it. Like you said, the Swiss Army knife, injection capital, 10-year loan, injection for the business to expand, to buy a business. With the baby boomers retiring right now, a lot of employees are buying the business from their owners, so they can do an SBA 7A loan to do that. Real estate, equipment. I mean, it's so versatile and it's very powerful. And believe it or not, even though I only specialize in 504, which I will talk about right now, I consistently inform my clients that the 7A program does exist, because it is a very powerful program. And I think it's something that's not spoken enough to some of these small business owners, especially for the injection of capital, business acquisitions. I see a lot of those right now. So now let me get into the 504 program. The 504 program, there's two main things that we do with the program. The majority of the 504 loans have to do with commercial real estate. I would say that if I had 100 SBA loans that I've closed in the last 2 years, I would say that maybe 198 of those deals were real estate and 2 of those deals were equipment. I'm doing a painting booth for a large company for about $1.2 million right now with Chase. And it's all 100% equipment. The terms are better for the client. The amortization is better for the client. It's just a powerful program for equipment. The other deal, I can't quite remember top of my head, but there was a purchase of a business with a building, but it had a paint booth in it. And we had to finance the paint booth as part of the 504 program. Works perfectly. But again, I would say 95% of the 504 program deal transactions that I work on are specifically for commercial real estate acquisition. So let's talk about the flexible use of funds. Let's look at that little section there. It helps small business purchasers expand commercial real estate and acquire equipment. I just talked about that. So what's flexible about it is that you have both. You can buy the equipment. Oftentimes you buy the business, and there is refrigeration in there, or there's some type of equipment that's in there that's part of it, and we can do the equipment acquisition as well. Because when the seller sells a business that's very dependent on that equipment, it's very common that they'll sell the building plus the equipment from it. So that's the flexible part of it that you can do for both. Number 2, less out of pocket. As a business owner myself, when I had a turf company and I had a painting company and I had employees and working capital is very, very, very important for the business. I mean, making payroll, paying the bills. I mean, you're constantly being stressed out about having enough working capital to keep things going. So a business owner has been leasing for 3, 4, 5, 7 years. They've been making all their payments. And so out of their net income, they try to save a little bit of money as much as they can and keep equity in the building, or save money within the personal accounts so that they have the ability to maybe buy a building one day. Being able to purchase a large commercial real estate transaction with only 10% down, it's powerful. I can't tell you how powerful that is. That's why the 504 is so powerful, because having 10% down payment to buy a commercial real estate building, it's just one of those things like, oh my God, it's almost like the FHA loan for residential, right? When you need 3% down and whatnot. It's not exactly that, but just the ability to buy a building with 10% down versus if you go conventional, you're going to need between 20, 30, 40% down, depending on your cash flow. So less out of pocket. That means that you have more money available for working capital, more money to continue working on your operations. And it also gives the client a confidence and conviction that, hey, you know what? I have 10% down. I'll definitely move forward. But if you ask me now, 20%, that's going to be tight, especially when we're talking about $1 million, $2 million, $8 million, $10 million, $12 million property. It's very important to understand how less out of pocket is what makes a transaction happen. Number 3, maximize cash flow. Okay, well, what does that mean? Maximize cash flow. That means you get more money coming in. I think this whole thing about maturing, doing a 25-year fix, fully amortized. Think about, where I live right now. I have a beautiful place where I live at. Every month, every year that I renew my lease just keeps going up and up and up. I think here in Long Beach, the maximum they can go is 8%. And I've seen rents go up, not only for people personally, but for business owners. They sign a lease for 3 years, 5 years. Very rarely do I see a lease payment go down. The rates go up. So when you can't really maximize cash flow if you have an increasing amount of fixed of costs for your business. So 25-year fixed loan, or your payment's not going to change for 25 years. That's going to help you maximize your cash flow because you are now pinned for 25 years any other additional income that you make, any additional rent that you would have made on that payment increasing over years, now it's going to go to your cash flow, right? Because you're not working on paying increased rents over 3, 4, 5, 7 years, maybe even 10 years. The fourth one here is called low rates, competitively priced rate structures. The prime rate right now is at 6.75. It's been dropping down since last year. Our CDC rate is based, not to get into complicated stuff, but we're Treasury bond money. That's where we kind of go off the 10-year Treasury. It's at the 25-year fixed rate is at 5.85%, 5.86 for refinancing. So think about that. If prime's at 6.75 and we're offering rates at 5.85, I mean, that's great. And the best part about it is that it doesn't matter if it's a B of A client with great credit or it's another type of lower credit. The client's going to get the same rate regardless on my loan, 5.85%. And that's really powerful. Very rarely can a client get this type of rate if you have a bad credit or not as good credit. Does that make sense? So partner with a certified development center. In our world in banking or in finance, you have business bankers, you have SBA specialists like Omar right now. So Omar is kind of like, I remember like the military. I was in the Marine Corps for 8 years. Omar, to me, he's a sniper, right? All he does is he's got a very specific job. SBA is what Omar does. You got people like Eddie Reyes. You got regular infantry guys, right? They're doing merchant services. They're doing credit cards, deposits, the treasury management. And I know this because I was one of you, right? So me, as I don't work for a bank, right? I work for a 501c3. I work for a not-for-profit. What does CDC stand for? Community Development Center. That's the mission of the CDC, is to help the community grow. And how do we do that? We do that by providing financing to the small business owner so they can grow their business, whether it's a 7A loan to inject money to grow the business, to buy a building so that the business owner can fix their payments, they can improve the property, hire more employees. The way a small business usually starts out of the garage, it starts out of their home, and they start leasing a location, a small little, 500 square feet, and it keeps growing. Guess what happens when a company grows? They hire more employees. You hire more employees, what does it do? It creates jobs, it pays taxes. It's a community development center. I don't know about you guys, but I've been in the boonies somewhere where there's no jobs, and everyone's fighting for the job at the 7-Eleven. I mean, this is the opposite. This is the whole person. This whole CDC SBA program is to create jobs and help the community grow. And so I tell people all the time. My clients ask me all the time, like, "Hey, well, what's your best rate?" I'm like, "Well, first of all, let me back up for you. I'm a 501c3. I'm here to help you. There's a lot of CDCs out there, a handful of us, I should say, not a lot of us, but our rates are the same across the board." And I've worked with other great CDCs. I'm partners with my other friends, other CDCs. They're great people. They're great human beings. But we are here to help the community. We're here to partner up with the bankers. We're here to bring the information to the client. We're here to help them understand how the program works. We're here to literally get next to their office when they're busy at the tire shop and help them fill out the PFS. A lot of these small business owners don't know much about how to fill an application. They don't understand how the program works. They need to see proposals. They need to see the numbers. And that's what we're here to do. We're not for profit. So again, when you hear the word CDC, don't think COVID, but put on my mask. When I put on my mask, think Community Development Center. So okay, so let me get more into this. I lost track here, but let me give you the structure of a 504 loan. I wish there was a pizza here because I always use the pizza. There's a circle. The bank, obviously Omar or US Bank, or any other bank, they're going to do 50% of the purchase price. $1 million purchase, the bank's going to do 50% of that. It's $500,000. They're going to do a lien on that property. So the bank's only in the hook on 50%, and they're first trustee on that property. Something goes bad, they're the first ones in line, right? Very low risk. Versus conventional that, or there's no CDC, they might have to be at 70, 80%, so it's a little different. My portion is 40%. It's always going to be 40%. And the customer comes with their 10%. So you got 10%, they bring 100 grand in, I bring the 400, and Omar brings the 500. Now we have the full $1 million. That's a 504 program. So the other thing I can say about this is that, yeah, basically that's all I have on this slide. I can't think of anything else. Let me just put this way. If something goes wrong and the company bankrupts, right? The deal goes sideways. The $1 million, let's just say let's say the market goes down by 10%, which is kind of rare for commercial real estate to go that deep, but it goes for, now the property's worth only 9 million. Omar's going to get his $500,000 back, right? So think about how more comfortable the bank is knowing that they're going to get their money back because they're in a low LTV compared to the loan. So that's why the 504 sometimes makes a lot of sense. And why the banks actually like doing the 504 as well. Not to mention the 7A. They got SBA versus conventional. We're talking about 7A versus 504. Okay, this conversation it's different. This one's going to be conventional. If the 504 program didn't exist, there's different rules. One of the biggest rules that we have with SBA, and people ask me, Eddie, can you do SBA to buy an apartment building? No. Can I use an investment money to buy a strip mall to collect rents? No. That's not the point of it. That's what we call speculative investing. If I get with somebody, my buddy, and we want to buy an apartment building, you can say, oh yeah, we'll create jobs because we're going to hire the gardener. We're going to do that. That's not the idea. The idea is that the program's designed for operating businesses who are going to occupy the business for operations, not to collect rents. That's called speculative, so it's higher risk. So the one rule that we require with SBA 504 is 51% ownership. Everybody who knows about SBA within the bank, that's the biggest rule. You have to occupy 51%. If it's new construction, like you're building, which happens here and there, the rule changes to 60%. But it's still, pretty substantial. You can rent out the rest, and you can collect rents on that if you want to, but we're not going to use those rents to support the loan. You have to qualify on that property on your own. It happens all the time. Sometimes I tell my clients, think big. You want to buy a 10,000 square foot building, or you want to buy 13,000 or 15,000. Well, buy the 15,000, and then slowly as you grow, you get a tenant and you finally kick them out after 5 years, and now you take over the whole property. It's helped. I see a lot of clients do that because they know they're going to grow. They know that they need the space. So a lot of times we want to make sure that they at least start with 51%. The max loan to value, it's 90%. Again, that means that minimum 10% down. The loan's going to be 90%, 50 with the bank, 40 with me. Now you see the conventional, the max loan to value, 80%, right? What does that mean? That means that the client needs at least 20% down. That's a typical conventional loan. Sometimes some banks want 25. It depends on the credit criteria. And the typical loan term for us, not typical, but we do have a 20 years fixed over 10-20. We do have a 10-year over 10, but most people don't like that because the payment's much higher. The clients want to maximize cash flow, so they usually do 25 over 25. I haven't done a 20-20 since I've been at the CDC, and I have not done a 10-10. It does happen. It's available, but 25-year fix over 25 years. Now, the conventional program, it can vary. It can be 5-year fix. It can be 7-year fix, 10-year fix, amortized over 25. So you got to remember that not a lot of banks offer 25-year fix over 25 on that 50%. The 5 or 10 is very common. The 7 is very common. Anything more than 10-year fix, the client has to be a little bit stronger for them to qualify in that term. Am I right, Omar, on that?
Yeah, obviously, and the pricing is a little bit higher on the longer term fixed.
Yeah. So if you want a longer fixed term, you're going to pay a little bit higher rate. So just keep that in mind. The rate fix options, we talked about earlier, we talked about 2020, 10-10, 2025. I think we can move on to the next one. Okay, so let's talk about this transaction. This is actually a real transaction that we worked on together with Omar, I think it was early last year. I think it was recently last year. Yeah. And basically it was, can we say the type of business?
Yeah, just the name of the business.
Yes. Yeah, so it was a gentleman who was leasing, and he has a pawn shop business here in Los Angeles. And the loan amount, so it's just a typical thing. He's been leasing for a long time, and he just wanted to buy the property. And one thing we don't talk about here is depreciation expenses, interest expenses. There's a lot of additional benefits besides just buying the property, fixed costs. The clients are paying rent, and that's just like everything else. It just goes out the door. But when you buy a property, you have additional write-offs, which are very powerful. But Omar, why don't you talk about this since you remember this client?
Yeah. So it was just a pawn shop. Obviously, he had the opportunity to purchase the building that he was in. And so he came to us, and obviously for us, we try to get Eddie or the CDC involved pretty early on, because when you do the 504 program, you pretty much run side by side with the bank, right? So there's two sets of applications, but it's pretty much the same information. So we try to get the CDC involved early. So we both collect the package. And for this client, the cash flow was really strong, and it was just a good opportunity for him to put 10% down and purchase the building that he was at.
Got it. Yep. So, yeah, I mean, I cannot really add this. This is a pretty smooth transaction overall. Our CDC, there's three things we do. They call it packaging, but we underwrite the loan, we submit it to the SBA, we get the approvals, and we service that client for the remaining time. So oftentimes when you say we're in tandem, the PFS, schedule of debt. If I get a package from the bank, a PFS, I'm not going to go ask the client to go pre-filled another application. There's nothing more frustrating for a client than to sign up another PFS. So we do our best to transpose all that information into our forms, or vice versa. We work together so that we can make it easy for the clients instead of filling two sets of work paperwork. And then we also tell the client also to CC each other. So if the client sends me the tax returns, we say, hey, keep us together in that email so that we both get the same package. The client sending the bank something and then sending the CDC something, it's just cumbersome. So a lot of times we approach the client together, we meet the client in person together, and then we come together to the client so that we can get the whole process as smooth as possible, if that makes sense. Yeah. I think that's pretty much it on my end.
Awesome, Eddie. Thank you. And just to add to this deal, right? It's a specialty retailer, a pawn shop, right? A lot of banks would probably shy away from something like that, but obviously with the SBA guarantee, to Eddie's point, it's a win-win for everybody. So, which is really good. All right. So last slide before I close it out is just really the difference between the 504 and 7A. So you've heard from the experts already, right? The answer depends, right, on your priorities. Obviously the 504 is built for owner-occupied commercial real estate, long life equipment, via a bank and CDC structure. The key features again were the fixed rates, the long-term maturities, the low down payment, all that great stuff. And then the 7A, so remember my Swiss Army knife example, it's just really a single loan that you can bundle a ton of things with, right? Which is working capital, renovations, furniture, fixture and equipments, and all kinds of other stuff, which is really neat. Both allow up to 90% advance rate, which is really cool, and it allows you to retain more funds in your account, right? So let me just close us out real quickly. Again, to wrap up, the 7A and the 504 remain two of the most effective tools for funding growth, especially when you need longer terms, lower down payments, and cash-friendly structures. Recent SBA activity continues to be awesome. I know U.S. Bank had a great year, as long as other banks as well last year. And lastly, I thank you for joining the LALCC meeting today, and thank you LACC for hosting this. Thank you all for joining. Eddie and I will stay on for additional questions. Please feel free to bring any scenarios, refis, anything you want to talk about. You have the experts here. We purposely allocated 30 minutes. We don't have to use the whole time, but some additional time to talk about your specific scenarios. If you don't want to ask the question now, obviously you have the QR code there, or you can ask it through the chat, and then Olivia can monitor that as well. So Olivia, I guess we'll start with the chats. Anything there?
Great presentation. Thank you for everything. I mean, very informative. Let me run through these questions real quickly. As you present SBA options, can you highlight several features available for service-disabled veterans? Is there any difference in any other programs specifically for veterans, or is it encompasses everyone?
Well, it does encompass, but there are special benefits for I know for the 7A program, the guarantee fee is reduced for veterans. So any kind of veteran, they get a reduced SBA guarantee fee for the 7A.
Okay. All right, perfect.
I need to confirm that to get exactly the amount, but I will get back to you guys on a specific question, because there's been a lot of that question lately, and I haven't got a clear answer on exactly what that discount is.
Okay. Samir, if you'd like to get in contact with Eddie, or Eddie, Mr. Reyes or Mr.
So I'm a
Santos,
veteran, so I'll definitely, if you're a veteran, I'll definitely figure it out.
that would be really great. So that way you can connect and maybe have a longer discussion. Eddie, you did provide your email at Eddie, EDI, at bfcfunding.com.
Correct.
So to explore more options, who do they contact first?
Good
Yeah,
question.
I mean, that's, we work really closely together. I think the best way to do it is contact me first, and then I can, triage that to the right person, whether it's a 7A or 504. But yeah, we all work together. I mean, feel free to call Eddie or Omar or myself. I'll drop Omar's email as well there, so you have it handy, but preferably myself.
And then, can you run with an actual loan that went through, i.e., the pawn shop loan was discussed, i.e., terms, rate, what prepayment penalties exist, refi options in the future, and if we can partner with other folks that are not partners in the same business, but may perhaps have a separate business. Also, these loans are based on just the business, personal guarantee. Lastly, what qualifies using 51% for the building? It's a
A lot
couple
of questions. Yeah.
Yeah.
So can you
Omar, you
run a
want?
scenario of a different
Different type of business.
business? Yeah.
I think, let me talk about this real quick. I had a client which is a small gardener, started doing landscaping, and little by little just kept growing. He needed more space for his trucks. And actually, the guy's a Marine Corps veteran, and he started getting these larger deals, like commercial deals. And he's like, "Hey, I had for the loan, but the deal, I'm only buying a $700 property. It's really small. Can you help me?" Like, I don't care. Like, let's get you in there. So I have these small little clients at 700, 800,000. I don't care. I just want to help the client out. You know what I'm saying? To me, I find so much enrichment in that. And at the same time, I'm working on a $14 million purchase, a distribution warehouse that this guy's just blowing up, and he needs the space, and he's got trucks all over the place. So the industry, it can vary. It can be from a small mom and pop shop to a sophisticated borrower. And especially now with the new changes happening with manufacturers, maybe doubling our SBA portion to maybe 20 to 10 million. I think there's going to be a lot more larger transactions happening as well. But on the 504, Omar's prepayment, every bank's got a little different prepayment. On our SBA portion, our prepayments is longer. I don't know statistically the details of how this information got back, but one of the cities I work for, they were saying that the majority of the projects that we work on, the client pays out the first within the 7 to 8 years. So by the time they're getting to our loan, there is maybe a small amount of prepayment left on it. But most clients, the prepayment is something that they're really trying to hedge. They know they're going to get a huge amount of money coming in, and that's where the prepayment questions come up. Almost like they foresee winning the lotto or something. But prepayment is typically not the issue that I see around. The issue is, can we get into the property? One more thing I want to say is that the banks typically look at historical. What does historical mean? That means that we look at the tax returns, right? We can see historically in 22 you made money, 23 you're making this type of money, and 24 you're making money. And right now people are giving us their draft of 25. It's a draft. A draft is it's not really cemented yet, right? They're still trying to put all the entries in there. But if the client doesn't really have the best cash flow for last year or 24, the SBA is very lenient. We can use projections for future revenues that will be able to be generated from that new property that might be a bigger size, that can increase their capacity. So doing projections is very important. People always tell me, "Eddie, I have an 850 FICO score," or "Eddie, I have a 550 FICO score." Yeah, there's limits to that, but the SBA portion on the underwriting part of it is very lenient, if that makes any sense. The SBA is always trying to figure out how to help the client out. The banks might be a little bit different, but the CDC portion is definitely very lenient.
Okay. And then I'm going to read more into this question. So if I'm reading it correctly, so they want to apply for an SBA loan. Can they partner with other folks that are not in the same business?
They can, obviously, depending on how much are they going to occupy, we can set it up as a co-borrower situation. So that gets a little bit into the weeds as far as the structuring of these loans. But yeah, it is possible that you have two companies that are occupying the same space. The SBA just needs to divide that up into which space each one is going to utilize, and they have to set it up as far as a co-borrower situation where everybody is guaranteeing the loan, and the cash flow is utilized for both businesses in that scenario.
Okay. Thanks
Omar,
for.
can you talk about, just on the spirit of examples, while Olivia gets the next question lined up? Can you talk about the client that we just saw this week, just high level, obviously, right? I think that one was an interesting one because obviously her landlord was going to sell the building, right? And and how she's kind of hedging around interest rates and kind of that dialogue we had between the 504 and the 7A and a little bit of that. I think that might be helpful for someone on the call.
Right. Yeah. So for her, obviously she has an opportunity to purchase the real estate, but I think they're just having some issues with negotiating price at this point. And then when we were talking, I kind of try to get what her anticipated down payment was, right? So initially, I mean, like I said, the 504 7A program is typically used for lower down payment, right? 10% down payment, and then you can amortize the rest of the loan over a longer period of time. But apparently she has a lot more to put down on the transaction. So when they're putting more than 20-30% down, I think the 7A program would be probably a little bit better flexible, because her long-term goals was to kind of ride prime down, right? So right now in the industry, a lot of clients that I'm seeing and that I'm sure Eddie's seeing, they feel like prime is going to continue to go down in the next 3 to 5 years on any kind of, because it could go up as well. If it does go down, a lot of people are opting to take a shorter term fixed rate, like a 1-year fixed or a 3-year fixed. And as prime adjusts, they can kind of ride that wave down. SBA 7A program carries with it a 3-year prepayment penalty versus a 10-year prepayment penalty on the 504. So after 3 years, the clients are able to be a little bit more flexible with what they want to do with the building.
Okay.
So some of the other questions that I see, I think it was Melvin that was asking, as far as personal guarantee, SBA always requires a personal guarantee. They'll never do a non-recourse type of transaction. And then as far as the size, that's 51% of the occupancy, it's by square footage, right? So they have to show, like, if there are tenants in the building, we're going to be collecting the leases, and usually the lease will have the square footage of that tenant space. And we have to prove to the SBA that 51% is going to be occupied by our buyer in order to qualify for the SBA. And there's some ways that you can kind of get creative with that, as far as if there's storage space or there's other kind of space that the business can utilize, so you can make a case for those kind of things. But typically by square footage, 51% has to be occupied by our borrower.
Mm-hmm.
Yeah, I just add one more thing here, because I mean, it's nice to talk about the technicalities of the program, which is very, very important. But I want to encourage for anybody out there who is considering this, or if you're a banker out there looking for clients, or business owners who are currently leasing, this is kind of ringing a bell. It's so powerful to just sit down with your banker and say, hey, look, I want to considering buying something. I have no idea what I can afford. And for us, like someone like Omar and I can look at a simple package. I've been looking at this deal I'm working on right now, trying to pre-qual this client on $2 million property. I go, look, I don't need that much information. I just need a personal financial statement. I need your 2 years of tax returns and your list of existing debt. I can run that quick analysis within 24 hours and sometimes even same day and say, hey, look, you can purchase up to $2 million. You can purchase up to $1 million. Or I say, hey, look, your cash flow is not there right now. You can only finance maybe 500,000. But let me show you on your taxes what you wrote off, and let me tell you where you need to be if you want to buy this property. And as a business owner, just seeing those numbers and seeing what your affordability is, oftentimes, because the rates are kind of relatively low and the leases went up so high, I have clients who are surprised that they could actually buy a building, and they could have bought one 8-10 years ago, and they never went through the process of asking a banker, can you pre-qualify me? And so I just want to make sure that after this meeting, think pre-qualify your clients, give them a proposal, give them the options, talk about the program, show them the monthly payments, and showing them what's possible and what's not possible. Because a lot of times the clients get stuck on the wheel, just running their business, doing their thing, and nobody really brings up that question and says, hey, look, this is what you can finance. This is what you can buy. This is what your payments look like. And the deals that I'm working on right now is because that conversation did take place. Because a banker sat down and said, hey, when is your lease up? Hey, has your rent been going up for the last 8 years? Hey, why haven't you bought a building? These are all questions that, are very powerful when you're sitting there with your customer. And this is how you kind of uncover these opportunities for the clients.
Mm-hmm. Well, thank you for the deep dive on that. So we have another question. My business uses US Bank. Should we go through US Bank to apply, or CDC for a 7A loan?
Go through the bank. Okay.
Alrighty. Next question.
No, no,
Can
no, no. I'm curious. Let's talk about that real quick because it's important. Omar, what do you think about that?
Yeah. So obviously, yeah, it'll go to Eddie. So Eddie Reyes is kind of the quarterback, right? So it always start at the banker, and we work closely with the CDC. So if it fits in the different programs, so SBA 7A, obviously the bank does. If it's a real estate transaction or a big equipment purchase, then we would automatically get Eddie Santos with the CDC involved. But initial contact would always be, in this case, Eddie Reyes, the U.S. banker that you have, to kind of discuss what the need is, and then based on that need, we would provide the solution and the appropriate
100%.
partners for that.
And don't forget, we're talking very formally here, professionally and whatnot, but we're friends. We know each other very well. We've known each other from Wells Fargo, from other banks. So it's like we're kind of a huge cohort here in the community. So if it goes to Eddie Reyes, there's no doubt in my mind that if it's a 7A loan, it's going to go that route because it needs to go that way. But if it's 504, and Eddie, I need a pre-qualification. The CDC does move fast on 504s. There's a sense of urgency, which the way we move, not to say the bank doesn't. I'm just saying for us, because we're not a non-bank, I can really move a lot faster and get pre-qualify a client within 24 hours on a CDC if it's a 504. I can't pre-qual the 7A.
Mm-hmm. Okay. Alrighty. Can one use a small business like catering? So I'm assuming apply for a loan, correct? For an SBA loan? Or it would depend on what their needs are for the catering.
Yeah, there's no restrictions for the industry type. So any type of industry, as long as it's a business, it's for profit, then we can utilize the SBA program to help finance.
Okay. Next question. What determines the amount of a 7A loan that we can get approved for? I think it was touched upon earlier.
Yeah, so the amount it's up to 5 million is the cap, but the amount within that 5 million is based on cash flow, right? It's based on cash flow and the actual justifiable need for the business. So if the business needs to purchase some equipment or to need working capital to hire more employees, we kind of break that down of, let's say they need 300,000-400,000 for that, and then based on that payment, we need to make sure that the business can cash flow for that new loan.
Yeah. Okay. And we've thrown a lot of really large numbers, obviously, right? I think, all businesses are in different stages of their life, right? So we have small businesses, medium-sized businesses, large businesses, right? So I think another reason to really go to your banker or myself or whoever that is, right, is to help us get you to the right person, right? Because a lot of banks are actually segmented, and depending on the size of your business, we'll get you to the right individual. So I think that's important to note. But if you're out there and you're like, you're starting maybe at a different level or looking at a different loan amount, feel free to give me a call. Absolutely. And we'll partner you up with the right individual and get you all squared away.
Thank you. Do you consider awarded contracts not yet fully fulfilled? So I'm assuming as collateral or as, income.
Right. So I think they're talking about purchase order financing. So if they have a contract that's coming up and they need to kind of get ready for that contract with either inventory or some working capital. Yeah, that's definitely a justifiable reason. Obviously, we're going to take a look at the bank's going to take a look at the contract. And then based on that contract, we got to say, okay, we need to hire this many employees or we need this much type of inventory. And then based on that is our justification for the SBA. So that's typically a SBA 7A loan. That's what that's going to
be. Help them scale, correct?
Correct.
Okay. Another question. How does the loan process differ from a standard U.S. bank loan versus an SBA U.S. bank loan?
So typically the SBA program is a little bit easier to get qualified for. So as far as the debt service coverage ratio to get qualified is a little bit stricter, I guess, on the conventional side versus SBA. SBA allows closer to a 1-to-1 cash flow coverage versus conventional. You have to be a little bit higher than that. So it's a little bit more, lenient in that way. But obviously the paperwork is a little bit more. It is a government program, so there's going to be a little bit more paperwork to get it done. But typically it's a little bit easier guidelines to push through.
Mm-hmm.
Yeah,
Right.
obviously the banks, obviously we love that SBA guarantee, right? That I think Eddie kind of touched on that earlier. But most banks have a host of products, including ourselves, right? We got a whole equipment finance team, and we've done plenty of conventional deals. So again, I think Eddie touched on this earlier. Is talk to your banker, right, and really have a good conversation and dialogue around that. And most of them will guide you in the right direction, right? And if not, feel free to give me a call for sure.
And next question, how do you work with applicants that don't necessarily meet minimum program requirements? In other words, for applicants that are turned down, what options are there? And do you assign them homework so that they could reapply and qualify?
100%. I think that's kind of you don't want to come empty-handed to the client and come with bad news. You want to come up with solutions, right? And this is where, it's not just about the loan. It's not about just like, I mean, obviously, we're going to try to help the client out, but I pride myself in being able to sit there with the client and give them some pointers, like, maybe you're expensing too much, or having a conversation like, this is the number that you need for that to buy that property, and say, hey, this is the number that you need to show to your CPA, whatever it is, but this is the cash flow we're trying to target. It can get very, what's right, technical sometimes, because cash flow analysis on business tax returns, I mean, for us, it's simple. I mean, Omar taught me how to cash flow a deal when I first came to Wells Fargo. I didn't have I'm like, what is this? I looked at audited financials, it was very easy, but it's not like a FICO score. It says, oh, well, get your FICO score to 700 and we'll get you the loan. It's not that. That's not the way it works. You have to really understand your revenues, your costs, your depreciation, your interest expense. Like, there's just so much that goes into like looking and digging into the tax returns. But for me, at least, I dumb it down to my client. I'm like, look, the debt service is 0.75. Well, what's 0.75? That means that right now you're only able to make 75% of the required payment for this property. So we need to get you to 110% at least, or at least get me to 95% so we can use projections. But you're at 25%. We're way off on this deal. You don't have the financials to support that. So that's a huge part of actually what we do, because we're not just trying to close a deal, move on. We're trying to build seeds for the future as well. That client's going to turn around and say, hey, I remember that guy who came over and helped me out and explained things to me, but this is part of our whole process, is to educate the customer, not just try to sell them a loan, but help them like understand how the program works and the mechanics of it, but understand from a cash flow perspective. Literally sit there with their tax return and get a pen and say, writing things down and say, look, on a piece of paper, this is the payment that's required for what you want to buy. This is a $10,000 payment. You're only barely able to make 4,000 right now. So that's a huge part of it's part of the process. Not every deal that we do gets qualified, I tell you that. So it's very common for us to sit there and explain to the client how I'm getting ready, especially right now where we are. We're in January, right? Look, it's no lie. Nobody likes to pay taxes unless they have to, right? But a lot of times the CPAs, they want to minimize their tax burden, and they shoot themselves in the foot because they expense too many things out that they probably shouldn't expense themselves out. But once they know they have a goal and they have a vision of buying something, that customer is going to change their behavior and say, hey, you know what? Maybe I won't buy that piece of equipment. Maybe I won't do this. Maybe I won't do that. They become more strategic as to what's important for them to get the bigger picture of what they want for the future. Not think myopically or short term, think long term. And that's part of our job as well.
So the next question, does CDC facilitate a microloan program like Impact Business Capital?
Yeah, so we have a program that we just launched last year, and I think some more CDCs are doing this now than before. But we literally have a whole department, a group of underwriters and processors who are doing these loans now. So most of it's like an injection loan for maybe up to $300,000 termed over 10 years. So there are programs. Every CDC has a little bit different. The Community Advantage, I know that TMC and I know when I was working at SoCal, they were starting to develop these programs. So we don't just want to be a CDC just providing commercial real estate loan. We're going to, since we're already with the community, I think that we're noticing the importance, not just we, but the SBA is encouraging the CDCs to provide these other additional soft programs. So they do exist. So every CDC has their own program that they're working with, this Community Advantage program. Like I said, it's just a matter of just asking the CDC what they have in mind, what kind of programs they have available within their CDC.
All right. And lastly, we have 6 minutes before we end, but this will be the last question. Well, three questions. How much income does my business need in order to qualify for a $5 million loan?
That's crazy. Let's do
Oh,
some
for a
quick
$5
math,
million
Omar.
business.
A $5 million loan. First of all, a $5 million purchase or $5 million loan. Let's just say a $5 million purchase, right? So the first thing we do, if it's a 504, which I'm hoping it is, if it makes sense for the customer, right? So $500,000. Let's do the math real quick. $5 million, right? Times 0.9. What is that? 4.5, right? 4.5 is the entire loan amount. Now, what's 50% of 5 million is 2.5 million, correct? So 2.5 million is what Eddie Reyes and Omar Kirsada is going to be US Bank's portion. My portion is going to be 5 million times 0.4, which is what? $2 million, right? So again, the customer's coming with 10% of 5 million. The customer's coming with $500,000, right? Okay, so let's start from the top. 50% is 2.5. My 40% is 2 million, and the customer's coming with their 500. So that's 2.5 and 2.5. That's total project of $10 million. So I'm just gonna rough ball. I'm just gonna get an eyeball. But so we're financing a total of $4.5 million. So the way we look at this is we look at the present value being 4.5 million, right? 4.5 million. My rate right now is 5.85. Let's just say the
For
bank rate.
simplicity, yeah, just use 5.85 for the bank as well. Just
Okay, let's just, yeah, because the rates they're very aggressive right now. So 5.85 is the rate I'm going to use. And we're going to amortize this over 300 months because that's 25 years. And the payment for that loan is going to be 28,582, right? That's the payment. That's the payment that's going to go for both loans combined to that loan. So if the bank, Omar, I'll let you take this part of debt service.
yeah. So basically, if you multiply that by 12, and you get 342,000 annually. So
and then what?
So we would need to see approximately, to be safe, around 400,000 of net income to be able to support that loan. So
How much?
after expenses, well, so that's how once we look at the tax returns, we kind of see what the net income is. Obviously, we have depreciation add back. We have any other add backs that we have in there. We add that up, and that number that we end up with needs to have a net of approximately $400,000 to be able to qualify for a $500,000
Okay,
loan.
pause.
Or $5
Pause
million
right
loan.
there.
Sorry.
Pause right there. Pause. So let's just go back, right? The payment's 28,582 times 12 months. It's going to be 342. Let's just say $342,000. Then we want to see a 10% cushion, right? So you multiply times 1.10. So you're going to need 377,282. So if the client's already paying $25,000 in rents a month, we add that back to the equation to make it even, right? So if the client's paying the $25,000 rent and he's still showing $400,000 of net income, he's doing amazing because he's already making the payment. Plus, we're gonna add back the 25 grand that he's already making. He's got more than enough money. But if he has zero net income, let's say he does everything, he's got zero net income, and he's paying already the $28,000 a month. That's kind of getting the ballpark idea. Again, this is it's a great question, and this is the type of stuff that we're doing every day, doing numbers. We're literally kind of a little nerdy about finance. We're literally looking at cash flow. If the client had a lawsuit and it was a $300,000 lawsuit, that's a non-reoccurring event. He's going to have a loss, but we got to dig into what's going on with the financials. If you bought a piece of equipment and he used Section 179 and he depreciated 500 grand, you can't, that's going to show as an expense, but that's a non-cash occurring event. We add those items back. So that's why it's not easy to just sit there and say, how do you qualify for it? What do I need to show? Well, you need to show us an opportunity to sit with you and look at your financials and give you the exact data points that you need. It's not as easy as well, I made $300,000 last year. Okay, that's cool. Or, hey, I'm not going to qualify because I had a loss of 200,000. I have clients who have shown losses in paper, and when we go back, there's so much cash flow to actually do the deal. But the clients in their head thinking like, I'm showing a loss, I'm not going to qualify. Absolutely, the worst mistake ever. Even some sophisticated, smart business owners don't understand that because, or even bankers. I talk to bankers all the time. They're showing a small little loss, and they're not going to qualify. I already looked at his financials; they're showing a loss. I'm like, there's more going on than just a loss.
Because I know we're up for time. So is there any grants for minorities and women-owned businesses to lower the down payment from 10% to 5% or even 2.5, or any other matching grants to lower the down payment.
Eddie, I don't know if you guys have.
I mean, to be quite frank, honestly, I don't have the details in front of me. I know for a fact that the SBA requires a minimum of 10% down. I do know that there's other companies out there, I'm not going to say what they are, and they try to get a loan outside for something else to use it as a down payment. I'm not the SBA police here. I don't know how those programs work, but I've even heard of 100% financing. But I know by the rules of the SBA and the spirit of the program and the way the program's supposed to be used, there's got to be at least 10% skin in the game. That's the minimum requirement. If the client wants to put 20%, the SBA can still do the loan. So think about that too. But at the very least, the client needs to put their own 10% down into the property.
Okay. All right. And then on that note, I'd like to thank everyone here, Omar, Eddie, for presenting, and US Bank for the support and partnership in allowing the Chamber to put programs like this together. You know, it really takes a team to build these type of webinars for our members and our community. So thank you very much.